All right, welcome. My name is Greg Urban. I am a tax partner with Dopkins and Company. With me today is my partner Teresa Majors. What we want to do in this brief segment is go through the Tax Cuts and Jobs Act and specifically talk about the business provisions in that act. Teresa, when you think of the business provisions, what do you think is the headline, or what are the areas that maybe get the most attention?
So I guess during the whole process of tax reform, we heard a lot about corporate tax cuts, and probably thinking about them in two pieces, and we'll break them up that way. One is the C corporations, the traditional taxable corporation, and then there's the pass-through entities, so the S corps, the partnerships, Schedule C business. So the business provisions address both of those. So on the C Corp side, we all heard that the corporate tax rate went way down. It went down to 21%. It's a flat tax rate, but the old corporate tax rate was 35%, so this is a big deal for corporations.
Yeah.
The other thing that happened was at the corporate side, AMT is repealed. So a lot of the corporate clients had run into alternative minimum taxes and maybe had limits on other things that they could claim in terms of credits and incentives. So this is good for the corporate tax world. The other thing to note with these corporate changes, these C Corp changes, are permanent.
Yeah.
So this law is good law for the foreseeable future.
Yeah.
So in order to create kind of a more level playing field, though, we gave all the C Corps a great break, but we want companies to operate in the best business structure for them, not just for tax purposes. So what did the in a horse trading, what did the S corporations, the partnerships, what did they get out of
Right.
this?
So yeah, big part of our practice is S corporations, partnerships, sole proprietorships. Those businesses, of course, the income passes through to the owners. Those owners are subject to a top rate of 37%, up to 37%. So you're right, there had to be some parity that's created between a C corporation and a pass-through entity. When I think of the new deduction, one of the headlines that you see is a new qualified business income deduction that's available to those.
Or the 20% deduction. I mean, that's, you hear all the time, we're getting a 20% deduction.
Yeah. And when I think of this, I think of, look, for I think we think of it in terms of income thresholds. For taxpayers that are have taxable income less than $315,000 that passes through, their deduction is likely going to be 20% of the income from those pass-through entities, the partnership, the S corp, and the sole proprietorship, no matter really what business that they're in. When income gets above that $315,000 threshold, then I think you got to start to ask a couple of questions. The biggest of which, there can be some limitations that come into play. Maybe the deduction is no longer limited to 20%. Maybe now we've got to consider a second limitation, which is based upon the 50% of the wages that those entities apply. So, I think taxpayers and our clients that are in pass-through entities like that should be thinking in terms of this 20% deduction, but there can be some limitations.
And that, just to clarify, that $315,000 number you're talking about is a married filing.
That's right.
So if you're, it'll apply similarly to a single taxpayer, but the numbers are a little bit different.
The other thing is, when you think of this deduction, you ask yourself, does it apply to all businesses, or is it apply just to certain? One big caveat when we get above that $315,000 threshold is the benefit to service businesses begins to phase out and can be completely eliminated.
And what's a service business?
Yeah, so they went to great lengths in the act to define service business, but really it would be a law firm, an accounting firm, medical practices, those types of businesses where personal services contribute largely to the income and the operations of the business. So. Yeah, it's a big deduction. Certainly will provide a lot of benefit for our clients. Above that $315,000 threshold, it just may phase out or become not available to certain service businesses.
Yeah. Any gray areas in this deduction?
Yeah. So probably the grayest area of them all is that wage limitation that I
Right.
referenced before. When you get above, the married couple gets above $315,000, the deduction is not necessarily 20% of the income. It can be limited to 50% of the W-2 wages. Well, what happens in the area of a partnership who might make guaranteed payments,
Or sole proprietorship,
or-
you're the only person working in the business.
Yeah, and I think what we know right now is that there's just got to be some additional clarification so that businesses, so partnerships and sole proprietorships are on parity with an S corporation.
Sure, yeah. And I've had a couple questions on the service businesses, and while there's certain enumerated service businesses that this does not apply to, there's also some very gray language that we're going to need some clarification on.
Yeah.
Yeah.
One other area when you get beyond the qualified business income and the deductions to pass-throughs and corporate rates is in the areas of depreciation. Big deduction for a lot of our clients. What do you see in that area?
Well, it's just the deduction starting in 18 is even more generous, and so the depreciation is accelerating faster and faster. I guess what I would say is, there's a lot of these rules keep coming in, and every year you have to be really cognizant of some of the nuances and the dates, because everything is dependent on date, place, and service, and then there's a phase out 2 years, a couple of years into this. So it's very technical. You really have to pay attention to it. Another change that from the business perspective is on the entertainment deductions.
Yeah.
So it's pretty common for a business owner, say, to take a customer, a vendor to a hockey game, something like that. And so in the past, those expenses were generally deductible to the extent of 50%. So you had a 50% disallowance. Unfortunately now, that type of entertainment expense under the new law is no longer deductible at all. So, when you're keeping your records, you're going to have to think about how you would break that stuff out. The other maybe business-related provision that I would think of that we see fairly often is like-kind exchanges.
Yeah.
So like-kind exchanges for real estate, totally not affected by this, but what we see on businesses is specific. The big one is autos, right? Companies are always trading in autos. So going forward in 18, you have a gain or loss on an auto trade-in, you're just going to have to recognize it. You can no longer keep rolling it. One thing that I was thinking about too on the qualified business activities deduction is just that's another one that's got a shelf life on it.
Yeah.
So that's from 2018 to 2025, and after that goes away. A little different than the corporate rate, which is permanent. So there'll have to be more to come on that. I would expect. Yeah.
And then in this area, I think there's 3 other provisions that I think our clients talk to us most about. The first might be the limitation on business interest. So prior to this Tax Cuts and Jobs Act, business interest was for the most part fully deductible.
Yeah.
Now there's a limitation. It's 30% of a term adjusted taxable income, which I think for purposes of this segment, what's important to know is that certain businesses just think of a potential limitation on that deduction for business interest. There's certain carve-outs. Certainly it wouldn't apply to smaller businesses with less than 25.
Real estate.
It doesn't, right. So less than $25 million in gross receipts, real estate. We have a lot of clients in the automobile industry. Their floor plan interest that would be carved out, but that 30% of adjusted taxable income is a very real limitation. And then I think the last 2 areas, at least that we've had discussions with clients about, big one is in the area of net operating losses. So prior to the Tax Act, if a company had a net operating loss or an individual had a net operating loss, it could be carried back 2 years and then carried forward 20. With the new provisions, there is no longer a carry back, and that operating loss can only be carried forward. And then there's a further limitation that would say, used to be the NOL could offset really all of taxable income, right? So now it can only offset 80% of taxable income. So, just differences in the way maybe people think about the benefits of NOLs. And then the last area I think is kind of a new area, I think, the area of excess losses. I'm really only aware that it applied in certain, maybe farming situations before, but, taxpayers who have an interest in a pass-through entity, for instance, or maybe a sole proprietorship, if there's a loss from their businesses when you look at them together.
An otherwise allowed loss, after you go through all the other hoops you have to jump through to take a loss on a business.
After you get through passive activity and everything else, it can be limited on a married basis to $500,000 or to $250,000 for a single taxpayer. So, hopefully this short segment gave an overview of the business provisions of the Tax Cuts and Jobs Act. Certainly be more clarification and interpretation coming forward, and encourage you to contact your Dopkins and Company tax professional with additional questions.
Great,
Thanks.